morning, everybody. I want to talk to you all a little bit about what we're doing today. So we had a really excellent day yesterday. This is our, again, Louisville and Lexington ADU conference. It's designed specifically for the industry professionals in mind. My name is Chris Woodall. I'm the manager of long-range planning for the city of Lexington. We're happy to have you all here. I want to thank again the city of Louisville Planning and Design for helping us put this conference together and be able to bring this to you today. And then AARP Kentucky for their continued support of this conference and ADU initiatives throughout Louisville and Lexington. And then certainly the audience for you all coming back. For those of you who have stuck with us the whole time, we appreciate it. We've had a lot of good information so far. So with that, I want to recognize Milton Manolis, who's the Retail National Renovation Sales Manager for Loan Depot. Our presentation today is what are lending options for ADUs? So while ADUs are new to Louisville and Lexington, they've been financed in other national markets for a long time. So in this session, a lending professional, Milton, will with years of experience financing ADUs, will explain how to utilize traditional lending options for these units. So Milton, his passion for renovation lending is only surpassed by his devotion to spreading the word and presenting to the real estate community, which brings him to us today. He travels nationwide and sometimes via Zoom to present at seminars to assist real estate agents increasing their market share and protect their transactions. He firmly believes that this loan program will create amazing opportunities for growth, not only in lifting a home's value and giving the client their dream house, but also in benefiting the job sectors for contractors, retail hardware, and construction. He believes that renovation lending changes the lives of homeowners, it invigorates neighborhoods, and creates demand and competition for neglected houses everywhere. So with that, Milton, I'm going to hand it off to you, and then we'll be back at the conclusion to do a question and answer session.
Chris, thank you so much. And thank you for having me. Welcome, everybody. Let me do a quick screen share and get up and running here. And I appreciate everyone's time and joining us. There we go. Beautiful. So we're going to talk a little bit about renovation financing of ADUs. And we're going to go through some of the opportunities, the lending opportunities available. We'll talk about how these renovation loans work, just give you an overall, cover some of the key concepts, what you need to know. There's a lot of misinformation out there, and the opportunity with ADUs is massive. I've never seen it like this, right? So, you know, before we really get into it, let me just share a little, some of the trends that we've seen nationwide, things that we've observed that have been building and I think are going to continue. And it's important for all of us, based on, you know, our objective here and what we're trying to achieve to the housing stock and to put people in better position to understand these trends. So obviously the ADUs, they've been around for a while, and the component, the reason they're so valuable now is because of the housing shortage. And this housing shortage obviously is pushing prices up and putting a lot of people out of an opportunity to purchase. And you're able to essentially finance an accessory dwelling unit, whether it's a build or a remodel, whether it's a purchase or a refinance, depending on the market that you're in, and meet that, offset that demand. You have homes, you have families that are growing. We're seeing, you know, kids moving back with their parents and parents moving in with their kids, especially over the last 2 years, right? And families are looking to be closer together while at the same time needing more space. We're seeing, obviously, one of the biggest trend, everybody working from home, so many people working from home. And, you know, you may not have that separation that you'd like at home, right? And so people are looking for ADUs to have that office, right? That just, even if it's 20 feet away, right? It's somewhere that you go, somewhere that you walk to. Some of the other trends that we've seen is the wear and tear that properties are taking on right now. You know, they never really considered everybody at home, kids attending school online, you working from home, and you're there, pretty much the entire day, and you're seeing just appliances and fixtures and flooring and windows and things that you don't really think much about, have gotten so much wear and tear. They're just they just need repair. And so, there's some other trends we'll touch on as we get to the end, but those are some of the trends that really brought us here, and it's not going to let up, right? So what we're going to talk about is some of the options. I want to get rid of some of the myths out there, walk you through the process, even show you some photos. We're going to start with some before and after photos, just so you get an idea of some of the things that we've recently financed. Actually, the first set that I'm going to show you are projects that we just closed out over about a week ago. So the first one here, if you take a look, you see a home and they wanted to build an attached accessory dwelling unit. So they wanted to build out the garage, make that an ADU. They wanted to use this space right here in the middle, the gangway in the middle as well. So we were able to finance this project. This particular one was a purchase, and they financed it, purchased the home, and basically rebuilt the entire back end of that house side into an ADU. Beautiful. Here's the before. That's the gangway. And here's what the ADU looked like when they're done. That white structure on the side right there. Okay. Now, when you look at the interior, pretty cool. They did a good job. Okay. This was out on the West Coast. Okay. Had everything that they needed, right? An ADU, an accessory dwelling unit, needs to have a kitchen, living space, bedroom, and bathroom, right? Those are the 4 key components of an ADU. Could have more than one bathroom or more than one bedroom, but it has to have those key 4 components. So the next one, this one, little different. It was a detached accessory dwelling unit. So that was the front of the home. But when you look out the back, they had a nice piece of property. Looked like they had already begun or at least tried to build some type of detached structure. Quickly realized they couldn't. And so we stepped in with financing and basically completed the structure of a detached accessory dwelling unit. And in this case, this is the before. And here's the after. So not bad, detached, right? If you look at the interior, they did a pretty good job. They actually put in 2 bedrooms. Looks great. They did wonderful. And as we've heard yesterday was, you guys had great information yesterday. And I even learned a lot, and I really enjoyed it. And you heard a lot about, how ADUs are valued and what you need to be mindful of. And we heard about the different opportunities. And you look here and you see something being able to build this on your property and alleviate either some of that pressure from needing more square footage to potentially renting it, right? If that's the case, right? And so there's just, it's just tremendous opportunity to build value and to solve a problem and, put you in a great equity position. So when we're financing these accessory dwelling units, we're using renovation loans, renovation mortgage. A renovation mortgage is essentially, you can purchase or refinance a property, either one, and you can include all the additional money you need, whether it's optional or required improvements. So for example, in that first set of pictures, that first home, the main house, if you noticed, also needed some repair. And we were able to finance the repairs of the main home in addition to financing the build out of the accessory dwelling unit. Everything is done in one loan at the same time. Now, the way you figure this is essentially, if it's a purchase, and we'll talk about both a purchase and a refinance. If it's a purchase, you're basically going to take what the purchase price is, and you're going to add your total renovation budget. So for example, if you have a purchase price of $250,000 and your ADU build out is $100,000, You're going to add those two together. And that's going to give you your total acquisition cost. So that's 350. 250 plus 100, 350. Now your acquisition cost is 350. The entire transaction, the mortgage, the qualifying, everything is based on 350. Just as if 350 was the purchase price. So the borrower's down payment, their debt ratios, their mortgage payment, everything is based on the acquisition price of $350,000. So remember to always take the purchase price plus the total rehab, add those together, that gives us the acquisition cost. If it's a refinance, it's similar. You're going to pay off the existing mortgage. You're going to add in your total renovation budget, and that will give us our new loan amount, right? So if a borrower owes $250,000 and they're needing an additional $100,000, we're going to pay off the $250,000 loan just like a normal refinance. We're going to add in the $100,000 budget for the ADU, and their new loan would be $350,000. Okay. Now it's important to understand that when you do this and you come up with your new future loan amount, the value is going to need to support that. We're going to talk about that in just a few minutes. But the math is very simple. Okay. And it is one mortgage, one closing. It doesn't take any longer. It's not any more complicated. The title company doesn't really need to handle anything extra. We handle the draws and the disbursements and the inspections. So to the customer at closing, at the title company, there's about 3 or 4 additional documents that they sign. And that's really the only difference they'd realize. The loans disperse just like any other, same process, same mechanics, okay? Anything that the home needs, whether it's optional or required, whether it's an ADU that you're building out or some repairs that you're making to the home that are required, right, can be included into the loan. And then all those repairs are done after the loan funds. Nothing has to happen beforehand. So in that first photo, they were building out an ADU, they were making some repairs to the main home. Those repairs were required. Home wouldn't have passed health and safety, some minor stuff, but that's okay. It doesn't have to, because whatever the home needs, we'll finance into the loan. It'll be part of our renovation budget, and then will be fixed or repaired after the loan closes or funds. Okay. So I know I'm throwing a lot at you. It's exciting stuff, but it's important to understand, you know, the initial flow and some of the key components. So one of the other things you want to talk about, whether let's assume for a moment it's a purchase, is how the purchase contract works. And that's very simple. If you're doing a purchase and you're adding an accessory dwelling unit, okay, or doing any type of renovation lending, the purchase contract is the same. The only difference you need to do on the contract is essentially write in 203K if it's an FHA, which we'll touch on, or if it's a conventional or a VA renovation, you write in Reno. So next to the financing terms, if you select FHA, you're going to write in 203K. If it's conventional or VA under the financing terms, you write in Reno, R-E-N-O. The purchase price on the contract is the purchase price. So for example, we were saying 250. So if the purchase price is 250, then that's what goes on the contract. How much renovation, how much the ADU is costing to build out, or the fact that you're even building out an ADU for the customer is of no business of the sellers or concern, right? They have their purchase price. It's an as-is offer. As far as the property is concerned, it's as is. Any repairs the home needs will be financed within the renovation loan and addressed after loan funds. Okay. So the purchase contract, you get a lot of information out there that there's all this extra paperwork that needs to be done, and And it's a difficult process. It's really not. It's the same paperwork. It's the purchase contract. It's what we do every day. So I want to talk a little bit about the contractor. Now, there's no approved list. When you're building out an ADU, doing any type of work to an existing ADU, there's no approved list of contractors. The borrower, the client, always selects the contractor. HUD doesn't have an approved list. We do not recommend contractors. The customer has to find their own contractor. Once they do, the requirements for the contractor are pretty simple. The contractor has to have 3 references, liability insurance, and a valid license. That's it. If they can give us the references, they have their liability insurance, they have a valid license, and they can handle that job, they're good to use that contractor. One of the trends that we've seen recently, that I was going to bring up towards the end, was some of these prefab accessory dwelling units that we're seeing built. It's awesome. They're built in the factory, okay, modular. They bring them out. The site's already been prepped. They bring all the pieces, snap it all together, and they're done. And it's beautiful. And so the customer selects everything they want at the factory inside, right? Whether it's their paint scheme or their cabinets and the flooring and all that, and everything is built in the factory and brought out. And those transactions are wonderful. And a lot of those manufacturers are also the contractors, where they'll do the site prep, right? They'll pour the slab or they'll sub it out, right? But they're the GC on the job. And that's a growing trend as well. And you're seeing it if you've been following some of the other trends have been the tiny homes. Well, tiny homes are kind of like accessory dwelling units, right? They're just, small living space, bedroom, kitchen, bathroom. You can call it a tiny home. Different parts of the country call them different things, right? So here in the Midwest, they call it an in-law, right? A lot of times in Chicago, a lot of them are on top of the garage, which is normally detached. So you have a detached garage and they'll build out an apartment on top of it, lift it, right? And you can have in certain parts of the country, they call them casitas and all kinds of names. And so, but essentially, the concept's the same. And I just, what I'm seeing coming out of these prefab builders is pretty impressive, and they're doing it in short order. They're knocking these out in stable supply chain. They're knocking these out pretty quickly. So when borrower picks the contractor and goes through that with their contractor is going to be approved by us prior to closing. They're going to supply us those 3 items. We don't really check their financials. We don't really look at their bank statements, things of that nature, okay? But as long as they have those 3 items, they're approved. And then our company, what we do is manage the draw process. And whichever lender you use, ideally either that lender or the title company would manage that draw process. Now, some of the key components of renovation lending and some of the soft costs that you'll experience when financing an accessory dwelling unit can be financed into the loan. So every renovation loan is going to have a contingency reserve, 10 to 15%. The contingency reserve is emergency money. So something unforeseen comes up, you've got access to additional funds. So if an accessory dwelling unit, just using numbers, is $100,000 all in to put it together, you're going to have anywhere between a 10 to 15% contingency reserve. So 10 to 15,000 will be added on top of the 100,000. So an additional $10 to $15,000. Now that money is set aside. It's a reserve. And if they experience any type of hardship, let's say the material costs rise unexpectedly, or there's some type of additional site prep that needs to occur, something unforeseen, anything unforeseen really, then they can reach out and access that money, and that money is immediately available. Any of that money that is not used could then be a principal reduction and pay down the mortgage at the end. So the contingency reserve is kind of like an insurance, some insurance money on the side. Then we have a short list of some of the fees that customers can finance into these loans: permit fees, inspection fees, title update, any architectural, any consultant fees, environmental, any studies, any soft costs, any and all soft costs having to do with renovation can be financed into the loan and can be reimbursed to the borrower. So we can either reimburse them with proof of payment, or they can essentially request payment directly to those parties. Let's talk a little bit about the appraisal. Now, when you are financing an accessory dwelling unit with a renovation loan, the entire transaction is based on the future value. Purchase, refinance, doesn't matter. Essentially, the lender is going to take the architectural drawings, if it's a rebuild or a build, and they're going to take the bid from the contractor, and they're going to order the appraisal. Now, when we order the appraisal, we're not asking what the current value is. Doesn't matter. Doesn't matter what the purchase price is. Let's say it was $250. Doesn't matter what the purchase price is. What matters is what is it going to be worth when they're done with the renovation, when they're done building the accessory dwelling unit. So we're going to, in a purchase, we're going to give the purchase contract and the drawings and contractor's bid to the appraiser. And we're going to ask the appraiser to tell us its future value. So the appraiser is going to pull comps of properties with similar square footage. An ADU is ideal, right? If there's similar comps that include an accessory dwelling unit, right? And they're going to tell us, when you're done with the build out or when you're done with the renovation, here's what it's going to be worth. That's the number that needs to support the transaction. So back to our scenario, if it's $250,000 purchase, or it's a refinance and we're paying off an existing $250,000 loan, and the new build is $100,000, then we need the future value to be $350,000. And so the appraiser is going to market subject to. When they market subject to, they're basically telling us the future value. Subject to the completion of the ADU, here's what your property's worth. Here's what the home is worth, right? And so the appraisal is a very key component. And we tell contractors, when you're prepping your bid for an accessory dwelling unit, we need to be as detailed as possible. The more detail, the more information we can give the appraiser, the better. It's, appraising is an art form, okay? The attention to detail is critical, and they need those details because it all matters, right? And so it's not enough to just say, wood flooring, right? You want to tell the appraiser the exact type of hardwood floors, the exact type of countertops and cabinets, so on, right? The more detail we give the appraiser, the easier it is for them to complete an accurate appraisal. And that's what we're looking for, right? And so that appraisal comes back supporting our value, our total loan amount, right? Which is the $250 plus the $100. And then we can move forward and complete the transaction and close. And so the appraisal is a key component, obviously. And part of that is having as much information for the appraiser as we can. And that's why on a new build, you got to have the architectural drawings. They need to be able to see it, see the square foot, calculate the value per square foot or the cost per square foot, both actually and visually be able to understand what we're doing. And so it's really, it's the same appraisal, right? It's not some more complicated appraisal format or form, same thing. It's just that the comps are future comps, right? They're not current comps. They're comps based on what's being done. So let's keep going. All right, let's dive a little bit into an FHA 203K specifically. So an FHA 203K, let me just go back a little bit, tell you the history of how this came about. So many, many decades ago, HUD's mission has always been to have that positive impact and affordable lending. And, it works, right? And what they did with their 203K designation, when you hear 203K, that's just their renovation loan. A normal FHA, a non-renovation FHA transaction is a 203B. A condo, if you're going to buy a condo with an FHA loan, it's a 203C. Why is it a 203K? What does the K stand for? Can never get an answer to that. I have no clue. So, but a renovation loan is a 203K FHA, okay? And so what HUD decades ago wanted to do is they understood that it was important not only to offer this financing, but they wanted to give a customer, the borrower, the homeowner, the opportunity to repair the home, update the home, improve the home, because improving the home would improve the community and the neighborhoods and have a positive impact. And so that's why they rolled out this program, right? Because they understood that there were homes that needed work. And so they wanted to put home buyers in a position where they can purchase a home and also include all the money they need to renovate or improve that home. And like I said, improve the communities. And once you do that, once you start improving homes, communities and neighborhoods, they just start to flourish, right? And so that's why it's such a critical piece. And they've come a long way. And, the 203K is really, of all the renovation loans, it's a wonderful program because it allows for the lowest down payment option. And so I want to go through some of those with you right now. So essentially, the 203K is, like we said, one loan, one closing, okay? No different than anything you might have experienced in the past. 30-year fixed. Every renovation loan we're talking about today is a 30-year fixed without any prepayment penalty. The loans can be refinanced, they can be paid off, you can pay extra, you can sell it, do whatever you like, just like any other mortgage, fully amortized, okay? Your down payment is 3.5%. But remember, it's 3.5% of the total acquisition cost. So for example, if the purchase price is $250 and they're doing $100,000 to build out an ADU, then their total acquisition cost is $350. Your down payment is 3.5% of $350,000, right? 3.5% of the total acquisition cost. Everything else is financed into the loan. So your down payment and your loan amount is always based on the total acquisition cost. In our scenario, $350. Now, we went ahead and pulled a quick search on HUD's website, and you're seeing a max loan limit for an FHA on a single family at $420,000, it's $680. Okay. Now, that is the max base FHA loan amount. How much renovation is within that number, or how much of that number is purchased, doesn't matter. So you can essentially buy a home for $400,000 and do $20,000 repairing an ADU, or you could buy a home for $20,000 and fix up the home and build an ADU for $400,000. The max loan amount is the max total of the two, $420,680. Okay. Now, a couple of HUD specific ADU requirements. The accessory dwelling unit needs to be attached to the main dwelling. It has to have its own entrance, exterior, entrance and exit. But HUD needs it to be attached to the main dwelling. If it does not have its own outside access, entry and exit, then they consider it an addition. It's not really an accessory dwelling unit, okay? Because it doesn't have its own access, private access, if you will, okay? And you can only build an accessory dwelling unit on an owner-occupied primary residence. okay? So not too much. HUD is, other than the attached, and of course, primary residence only, and I think both of those fit nicely into what I heard yesterday. I think it's a great option. Being able to purchase, build an attached ADU, and your down payment is 3.5%, or refinancing using an FHA loan, and you can go to 97%, 97.75% loan to value, and building out an attached ADU. So the 203K renovation loan for an accessory dwelling unit works wonderfully. All of them really do. They just have different nuances, and we'll talk about some of those. The VA renovation is something very special, and I hold dear to my heart. And let me share how we do this with accessory dwelling units. So the VA renovation is something that I was involved in creating about 6 years ago. And we identified a problem where our veterans, they could not, they were getting locked out. They couldn't write an as-is offer. If the home needed any type of repairs, or if they needed additional financing to make repairs or updates, or build an ADU to a home, there was no option available to them that allows them to use their entitlements. And so we structured this VA renovation loan, and it works quite well because it really puts the veteran in a position where whatever the home needs and whatever that veteran's needs are, they can essentially rectify and build out an ADU. And so it's 100% financing on a purchase. So if the veteran wants to purchase a home, and these are on all VA renovation loans, right? Loan Depot this is not about Loan Depot. We are not the only lender that offers the VA renovation loan, right? Any of the products that we're talking about today are pretty standard now, right? And so what I'm hoping to do and make sure I come across correctly is I want you to understand the products, not so much about me or us. But with the VA renovation loan, you have 100% financing on purchases. You can do up to a 90% LTV on a refinance. So the veteran can pay off an existing loan, and we can roll in the money they need to build out an ADU to a maximum of 90%. But it's 90% of the future value, right? Right. So if the home is going to be worth more, you go to 90% of that number. Same thing with the purchase. If they're buying a property and they're building out an ADU, it's 100% of the future value. So the veteran still has no money down, as long as the appraised value, including the accessory dwelling unit, covers 100%, a max of 100. Okay. Primary residence only, single family. That's all that's available right now for the ADU. And they have to complete the project within 90 days. Now, in certain parts of the country, this may be a little bit of a challenge, okay? In cold weather states, in the Midwest, perhaps Northeast. But if you're in a warm weather state, or maybe your winters are mild, 90 days to build out an ADU could work, depending on the permitting process and any type of zoning requirements. There are some exceptions to that, but you want to be mindful that 90 is kind of the guide that Ginnie Mae and VA laid out there. Anything that they need, they didn't really want to restrict the actual work that was being done, but they did need to put in some type of time restriction, and that's where they came up with the 90 days. The ADUs can be attached or detached, which is pretty cool, right? On the FHA, it's attached only, but on the VA, it can be detached or attached. Now, one last thing I want to share with you on the VA renovation. It's 100 LTV, but it's the loan amounts. So with a 600 credit score, they can go to 647,200. But with a 620, they can go to $1 million. And with a 640, they can go to $2 million. And so depending on the type of home and obvious, I mean, being able to offer a veteran $1 million VA renovation loan, or a loan up to $1 million at either 100 or a 90 LTV if it's a refinance, and include building out an accessory dwelling unit, is a pretty special thing. This lenders are really using this program to help make these homes accessible. And it's a wonderful benefit to the veteran to be able to, whether it's lift gates and ramps, expanding entryways, retrofitting kitchens and restrooms, therapeutic pools. There's a lot you can do with this loan, and it's a wonderful product. And the ADUs are just, the tip of it and critical for it. And so let's keep going. Conventional. Now, there's a lot of different reasons to use a conventional renovation loan with an ADU. On the purchase, it's still a little as 5% down, 3% down if you're a first-time home buyer. Single family only, right? So if you have a multi-unit, can't build out an ADU. Single family dwelling with an ADU. You have higher loan limits. The conforming loan limit when doing a conventional is $647,200. So you're higher than you are in the FHA. Primary residence only. The ADU can be attached or detached. One of the nuances, like we spoke about in the beginning, when you're doing a conventional renovation loan for an accessory dwelling unit, the ADU may not have its own metered utilities. FHA allows it, conventional does not. So Fannie Mae requires that the ADU's utilities be tied to the main dwelling, okay? And so, other than some of those slight nuances, they pretty much all follow that same path. And conventional financing is very simple. You would essentially proceed just like a conventional loan, whether it's a purchase or refinance, and their purchasing would be 5 or 3% down for a first-time home buyer of the acquisition cost. If it's a refinance, paying off that existing balance, rolling in that accessory dwelling unit, the cost for it, and then using that appraisal to support that loan amount. And again, on a refinance, on the conventional, you can go as high as a 95 loan to value. So as long as the future value gives you that 5% equity, right, you're good to go. On the VA, 100% financing. On the FHA, 2.25% equity is all you need based on the future value. So, Chris, I wanted to stop it out. I got about 4 minutes early, but I want to open it up to any questions. I'm available and I'm looking forward to it. Let me see if you could. There we go. Okay. I lost the screen for a moment there.
Not a problem. If you could go ahead and stop sharing the screen. All right. Well, a lot of good information, Milton. We appreciate that. We do have a couple of questions that are rolling in here. And just having undergone a renovation of my own house, this was hitting home, and and some of these questions, and I kept thinking of different things, and you were answering them as we were going along. So a lot of good information. One of the things that I was thinking about was about the timeline for the construction. And I think you mentioned maybe it was the VA loan that said there was a 90-day construction period where it had to be completed. Are there similar restrictions for timelines for the other types of loans? How does that construction get reported? Is there an inspection? How does that work? And then on a similar train of thought, thinking about some of our delays in supply chain and labor shortages. And I know in our market, there's a lot of, renovation contractors are sort of hard to come by. And so a lot of that is challenging, and materials costs, sort of all those things. So can you talk a little bit about the mechanics of how some of that works as a homeowner might be going through some of those challenges?
Yeah, so really excellent point you bring up, Chris. So the 90-day rule with VA, that's specific to VA, okay? On an FHA, you typically go into the transaction with a time limit of 6 months. And HUD grants extensions up to a year, okay? you really don't want to go into it taking a year. An ADU shouldn't really take a year to build out. And so, but 6 months is normal. There's no, if they need extensions, if they need to say another 3-month cushion, there's no cost, there's no fee, there's no negative impact to anybody in the transaction. There's a progress report that really needs to be completed, right? So if we go past 6 months, they have to tell us why they need 3 more months. Okay, it's really as long as there's progress being made, then you're fine. And like I said, you can go up to a year. Fannie Mae is the same thing. Fannie Mae, you have to get done within a year, right? They'll tell you 6 months. If you're going to go past 6 months, they need a progress inspection. So they may want to see some photos and say, okay, what's happening? There's no cost. There's no negative impact, right? They just want to make sure the project hasn't stalled and it's progressing. Now, given what everyone's gone through over the last 2 years, requesting extensions and going further, going past those markers due to supply chain, cabinets and appliances and whatnot, those are acceptable, right? And so that's going to continue for the foreseeable future. So none of the agencies, HUD and Ginnie Mae, Fannie Mae, Freddie, none of them are in a position, are willing to, they understand what's happening. And they understand that a lot of permit offices and zoning departments, building departments, they were closed for months. There were no inspections. We were dealing with projects, Chris, that took 6 months, a year after it was done to get closed out in the system because we couldn't get a passing final inspection or closing out the permits. And that's okay. That's, everybody made adjustments to that. So we're still in that world. And if they need more time, they can. But when you're going into the transaction, you're going into it with a max in your head of 6 months. Now, as far as the specific to the supply chain, that's where that contingency reserve really played a key role, because we had seen that spike in lumber and the delays and just those prices, those volatile swings, and people were able to leverage that contingency reserve to make up for those potential losses, right? To offset those increasing costs. So hope I answered the question.
No, you absolutely did. I guess my sort of doomsday scenario thinking is what happens if you exceed, with those wild price changes, if you exceed that contingency fee. I know that's there for a good reason, but what's the relief valve there? What does a homeowner have to do?
So if we deplete the reserves and there's still short funds to complete the project, the borrower's going to have to come up with that money. There's no additional money because the loan is already closed and funded, right? So there's no additional money available to them other than potentially refinancing and doing another renovation loan via refinance to give them more money. But other than that, the customer really has to come up with the difference at that point.
Okay, good deal. Another question here about contractors. How much liability insurance do you usually expect a contractor to have?
1 million, which is pretty standard.
Okay. And then let's see, we've got 2 related questions that have come in here. So can you finance just an ADU, or does it need to be rolled into an existing mortgage? And then the next one is, if you already have a mortgage, can you apply for a separate loan to build ADU?
Good question. So what we talked about today is a first mortgage. It's not a second mortgage. It would have a first lien. So if it's a purchase, it would include purchasing the home and financing the build out of the ADU. If it's a refinance, or if you already own the home and have an existing loan on the property, you would be paying off that existing loan and you would be securing a new first mortgage, first lien. Now, just like any other, just as if you have done a refinance in the past couple of years, right? Same thing. You will be refinancing the existing lien and including the money for the build out of the ADU. You can potentially secure a second mortgage for just an ADU, okay? and take a second, and they would hold a second lien position on the home. But as far as those terms and requirements, and how much equity you have to have currently in the home, that's where it gets a little tricky. So let me just, not to go too deep into the weeds, but with a renovation loan, the entire transaction is based on the future value. So the value that the accessory dwelling unit gives you is part of the transaction. Think of it like this. If the accessory dwelling unit gave you 80% loan to value, then you wouldn't have mortgage insurance. You see where I'm going, right? Okay. So you're using the accessory dwelling unit's value benefit in the current transaction, even though it hasn't been built yet. Now, that's because it's a first mortgage. If you're securing a second mortgage, which may work, right? Maybe the best thing. If you're securing a second mortgage, then chances are that second mortgage is going to be based on your current equity position, right? So, but what we're talking about right now is a first mortgage, first lien position structure. Great question. Thank you.
Yep. Very good. So you'd have to have a pretty strong equity position to have that second mortgage to go that route. It just depends on your circumstances and which one would be the right.
Yeah, because basically, Chris, a lot of banks and lenders, giving a second mortgage is okay, right? But giving a second mortgage based on future equity is not, because if they're gonna take a second position behind a first mortgage, inherently that's greater risk, right? And then they're going to do it based on building an ADU and the equity that ADU gives you. Well, if that ADU doesn't get built, then there is no additional equity. And then they're in an even worse position, right? So they're in a much greater risk. And doing all that and potentially going in as an industry, going into a higher rate environment can get a little tricky. So,
yeah, that all makes sense. I appreciate that. Okay, so now from your perspective as a lender, another question that's come in. What potential pitfalls should planners avoid when writing zoning ordinances to permit ADUs? What makes it hard for lenders?
Oh, wow, that's good. That's good. I love it. Okay, hold on. Let me think. What zoning laws? Man, off the top of my head, you might have stumped me. I'm trying to think of one. I mean, so far I haven't really experienced. I mean, listen, what y'all are doing is 100% spot on and correct. Okay. I think, I guess it would depend on you. We'd have to go deeper into the weeds on variances, right? Because some places variances are frowned upon, right? Requesting a variance, and others they're a little easier with them. Having been born and raised in Chicago, they don't know what a variance is, right? This is the rule. You fall within this rule, and that's it. That's all, right? And not having that flexibility, I would say, Chris, is pretty important because the housing stock has evolved, the demands have changed, the way things are built has changed, and I think variances would probably be my answer. Wow, took me a while to walk through that and come up with that one.
No worries. Yeah, we've got a good audience here giving us some tough questions. So
yeah,
I appreciate it. And y'all keep them coming. So
yeah.
another one walking through here is somebody's asked questions about renovations. It says, what about renovations in neighborhoods where houses are less than $60,000?
Yeah, absolutely. Yeah, that's where they shine. That's I mean, and it's one of the things I didn't bring up with the FHA specifically, okay, is that HUD allows you, this is unique to HUD, to FHA. HUD allows you to tear a home down and build a brand new home. You can build a larger home. So imagine buying a home, tearing it down, building a home, building an attached ADU, okay, expanding the footprint of the home. The trick is that you have to incorporate the existing footprint. So you can tear it down to say the slab, and you can build a larger home, but it has to be where the current home sits, right? A lot of people don't know that you can do that with a renovation loan. And the limited housing stock that we have right now, this has become a big deal. And I say that because, you know, the house, that neighborhood where it's 60, 80, 100, maybe that's just where it's priced. Or maybe you're in a neighborhood where you have a house at 60,000 because it's not habitable, where it's been burnt out. So, you know, I want to share some of the extremes, right? So you can do it. There is no minimum really loan amount at all. And so, yes, I mean, that's where we find the biggest impact. The biggest value proposition is exactly in that market. And it has the most profound impact, which is what I love, right? I mean, like, I love being able to see the before and afters, Chris, right? And so if you think about what we all went through during the financial crisis 12 years ago, 13 years ago, 10 years ago, okay? And what happened to these homes, okay? Think now of the opposite. When you're doing a renovation loan for a first-time home buyer, and they're able to put on an ADU, and they're able to build out the perfect scenario for themselves and for their families, okay, the pride factor goes through the roof, right? Their happiness level goes through the roof. And when that happens, okay, the neighborhood, the community flourishes. I mean, you guys would see it, Chris, right? But it's pretty cool to see, you know, over time, right? And so, yeah, I mean, sorry, went a little long on that one.
No, you're good. Yeah, the ADUs certainly offer quite a bit of flexibility as a housing option. So it's nice to understand there's options to help get those financed. So another question here, if proposed improvements exceed future value, can you get a loan up to the future value and the buyer is responsible for the remainder?
So if you're going to exceed if the total acquisition price, okay, the let's say it's a refinance, we're paying off 250, we're doing 100,000 ADU build, 350, the value comes in short. The value comes in at 340, okay? Yes, the buyer or the existing homeowner, if it's a refinance, can meet that difference, correct? They would actually bring that money to the closing, and they would apply that money to the transaction. Yes.
Okay, we've got time for just one more. So this person says, I recently sold my house with an ADU above a detached garage. The appraiser said the banks would not lend money on the loan with the ADU listed as a dwelling unit. Since it didn't have a full kitchen, a stove, the appraiser listed it as a hobby space, so there wouldn't be any issue with the loan. How can our community work around this if we want to allow ADUs?
Okay, so an ADU, that's a really good question. An ADU, and I'll be brief, Chris, an ADU is an accessory dwelling unit, right? So you have the main dwelling unit, which would be the single family home, right? And the ADU is an accessory unit, right? It's smaller than the main dwelling, but in order to be classified as an accessory unit, it has to have that kitchen. I believe, I don't know if they said bathroom, but I believe they did mention it didn't have a kitchen. So that appraiser did the right thing, 100%, right? Now, you could have financed, or that client could have financed adding a kitchen to the accessory dwelling unit, right? Or finishing, taking that existing space and making it an official ADU. Okay, they could have done that, okay, if they used a renovation loan. Hope I answered that.
Yeah, very good. And like you said, we're closing up on time. Like I said, these conversations always go so quick, but Milton, a lot of excellent advice out here. We appreciate you spending some time with us today. But our next session is going to be Florentine Christian, who's the founder and CEO of Sidekick Homes from Los Angeles. So we're really excited about that one and hope you all will join us for the next one. And then, of course, we'll have our conclusion at 11 o'clock.